Hello and welcome to this session on addressing the investment challenge of net zero. My name's Gordon Edge, I'm the Head of Strategy at the Low Carbon Contracts Company. I'll go into what we are in a minute, but welcome again to my panel of distinguished guests. We're going to discuss what it's like to bring a lot of capital to the table, which is what we need if we're going to completely retool our economies to be zero carbon. How can we do that at least cost? How can we do that accessing the biggest, largest and deepest pools of capital? We think that's a role for policy, and we believe it goes beyond where we've taken the most action, which is in the power sector. With me today, I have Ollie Cas from SSE, who's the Financial Director of the Dogger Bank projects. Congratulations on selling some stakes down of the CE project.
Thank you.
I have Ruth Herbert, who is the Chief Executive of the Carbon Capture and Storage Association, bringing perspectives from the wider decarbonisation. And there's my CEO from the Low Carbon Contracts Company, Neil McDermott. I'll ask them to introduce themselves in a minute after I've gone through some introductory slides, just setting the scene for what we think is the important issues for this topic. So, how do we address the challenge of investment? We think we've got a really interesting instrument known as a low carbon contract. This is generally known as the CFD in the power sector for the GB market, but it can be more widely applied. Before I start in earnest, a little word about the Low Carbon Contracts Company. It's an interesting beast because we are a privately set up company, but with all the shares owned by the Secretary of State for Business, Energy and Industrial Strategy. As such, we're in there to be the independent counterparty to the private law contract that is the contract for difference, which is the support for low carbon renewable electricity in the GB market. And was created 7 years ago as part of the Electricity Market Reform Programme, which created the CFD and the capacity market. We have a vision now to expand beyond the electricity sector and accelerate net zero more broadly. We're doing that by using the experience we've got in the CFD to shape and implement future mechanisms which will deliver that. We also have a guiding principle which is about maintaining investor confidence in our systems, but at the same time delivering best value for the consumer, minimising costs. And we believe that actually these are not in conflict, these are completely consonant. We have a number of current roles, which is counterparty to the CFD. Also, we settle the CM for the capacity market we have in GB. What we're also being asked to do is be counterparty to new roles. In the power sector, we have the dispatchable power agreement, which is the power CCUS, and we also have being brought in to settle the new regulated asset-based model for new nuclear, and which has recently gone into Parliament. Outside of the power sector, we will be have been named now as the counterparty to a new mechanism for industrial CCUS. I think Ruth will be talking a little bit about that model in more detail. We're also talking to government, and there's a lot of discussion about whether there is a role for a similar contract in the hydrogen sector. Potentially even there'll be consultation on this for sustainable aviation fuels. So there's a success in the power sector is being translated across to other sectors. Now, why is that? And that's because with net zero, the emission reduction effort needs to go more widely than it has in the past. Up till now, the power sector has been the real lead in the UK and has provided most of the emission reductions. This graph comes from the Climate Change Committee's 6th carbon budget advice and shows where it thinks all of the various emission reductions need to come across the economy. The biggest slice of that is surface transport. A lot of that will be addressed through decarbonised electricity, which is the second of those big slices. But there are also big chunks in manufacturing, construction and in fuel supply. And this is where we think there is a lot of leeway for new instruments to make things happen. Again, from the 6th carbon budget advice, this is some numbers abstracted from their advice around the amount of capital that needs to flow into the economy and flow into these sectors to decarbonise them. Overall, they're talking about £50 billion a year, but about approaching half of that comes from, yes, the power sector, which is the biggest chunk here, but also increasingly manufacturing, construction, and the fuel supply sector, which may lead us towards hydrogen in a big way. So there are big investment challenges. How do we make the money flow to those sectors at the lowest cost? What we have in the power sector is the CFD, the contract for difference, and this just illustrates that in a graph. It's two-way CFD. There is a strike price set through auction. If the reference price is above that, then the generator pays. If it's below that, then we pay the generator. We levy electricity suppliers on a regular basis to make sure we have the money to do that. And indeed, if the power price is high enough for long enough, we will be paying back. And indeed, we're anticipating some payback this quarter because the power price has been so high. So it's worth noting that structure is purely about money. The CFD is purely a contract to pay or be paid depending on the difference between the reference and the strike price. It is nothing else. The power generator needs to arrange its own route to market, power sales, but this mechanism, it stabilises the revenue and gives people certainty around price, and that gives a lot of comfort to investors, and therefore they can get access better capital. But alongside that revenue stabilisation element is the fact, as I've alluded to at the start, of we have the Low Carbon Contracts Company as an institution, this arm's length, private law governed institution, which gives extra confidence to investors. All the remedies that apply in normal private contract law are available, including dispute resolution methodology, and we've been through a number of arbitrations around our decision making in the contract, completely are governed by the normal legal principles involved. The fact we have some flexibility and discretion to work as partners with our counterparties to make sure that the projects are delivered. There are force majeure elements in the contract which allow us some flexibility in timing, and other factors which allow developers to know that we have some flexibility and allow them that benefit. And the fact that our levy raising is very stable and dependable gives confidence that we have the money to give. And now with a track record that we have of a stable counterparty, that adds to that perception. So all of these add up to an increasingly positive view of risk under this mechanism, which allows lower risk, larger pools of capital to be accessed. And that's illustrated by my last slide here, which shows some analysis we had done a couple of years ago, where our contractors went and looked at some publicly available information about who was investing in CFD projects and when, and also comparing the original idea of EMR when we thought, when would particular types of investors come in, and what we're seeing that particularly with infrastructure funds and pension funds, they are investing earlier than was anticipated during the electricity market reform process, which says to me that's a very successful way of reducing risk and bringing in new capital. So for me, that's the scene. I'm now going to pass on, introduce each of our panellists to introduce themselves and where they're coming from in all of this. And first off, we have Ollie Cas from SSE.
Thank you, Gordon. So my name's Ollie Cas. I'm the Finance Director for the Dogger Bank Wind Farm, as Gordon said. It's SSE's flagship offshore wind project. We were successful in winning CFDs for 3 phases of the project, Dogger Bank A, B and C, back in 2019. And we're developing all 3 of those projects sequentially, or about 1 year apart. Prior to being the finance director at Dogger Bank, I had a similar role on the Beatrice offshore wind farm, which was another of SSE's large wind farms off the far northeast coast of Scotland. And I noticed that the picture you had at the front of your slides, Gordon, was actually of the construction phase of the Beatrice wind farm. So it's great to see. Clearly, the CFD is been fundamental to those projects, and we're seeing it being deployed and working through the early stages of that on Dogger Bank. So that's where the interest for me lies in this topic.
Thank you. Ruth, where are you coming from in this debate?
Thanks, Gordon. So I'm the Chief Executive of the Carbon Capture and Storage Association. We are a trade association promoting the commercialisation and wide-scale deployment of carbon capture, utilisation and storage technologies. These are technologies that capture emissions of carbon dioxide from potentially from power stations, maybe from industrial processes, transport and store that safely under the seabed. And we've been working closely with the UK government for the last few years on trying to develop low carbon hubs or zero carbon industrial hubs around the UK with this technology, and looking at what kind of mechanisms will bring that investment in those sort of low carbon industrial areas forward. And I'm hearing at COP today talking with other countries about their experiences, and also about how we can develop the right standards to make sure that those sort of projects can get going and get the capital that they need.
Thank you. And last but not least, Neil.
Hello, I'm Neil McDermott. I'm the CEO of the Low Carbon Contracts Company, and actually the Electricity Settlements Company, which deals with the settlements in the capacity market. It's been a really interesting journey over the last 7 or so years since we set up the companies, and been fascinating to see the growth of the renewable generation in GB, and the success of the CFD, and the impact it's had on the sector, both in terms of the price of renewable generation and the rollout of ever-growing volumes. And we look forward to allocation round 4 coming up very soon. I'm really interested to talk about what we observe in terms of the work we do with our counterparties and the projects, and with investors, and working with trade bodies to see how the CFD can be used in other sectors like carbon capture and storage, as part of that journey towards net zero.
Thank you, Neil. To kick off the discussion, I'd like to bring Ollie in. And you talked about how the CFD was central to Beatrice and now Dogger Bank, and that's such a huge project with many billions of pounds of investment. What is it about the CFD which was really beneficial in that? What features do you think are the ones that you would talk about most?
Yeah, actually, I think it's worthwhile just going back to the kind of the origin of the CFD, back to sort of the early 2010s or early to mid 2010s, and what was happening in the renewables market. And there's a real need to have a regime which allowed the maximum build out of new capacity, but also, particularly in some technologies, in particular offshore wind, drive real cost reduction to allow kind of commercial scale development on commercially viable terms for everybody, including the consumers. And I think that was the origin of the CFD. And coming in, as you mentioned, the key feature of the CFD is the strike price. So it ensures that we know exactly what we're going to get for every megawatt hour of electricity that's actually produced. It doesn't give revenue certainty because we still have to produce the electricity, and so to a varying or greater degree, depending on the technology, you have more or less revenue predictability, but it gives a good level of revenue predictability, and that really is the key feature for CFDs and for investors looking at kind of the whole spectrum of risks. Being able to understand that revenue risk, the long-term revenue risk, is absolutely fundamental. I think it was very much at the outset, it was probably sort of explicitly kind of made clear that the cost of finance was seen as one of the drivers of getting cost reduction, driving cost reduction. So in maximising capacity being built would kind of enable the industry to mature, but then specifically trying to reduce the cost of finance with this regime, which would allow greater certainty over a core risk, which is the kind of the operational revenues, basically. Sorry, you about to...
Well, I was going to ask, and the structure, the legal and institutional structure with low carbon contracts, is that giving you extra benefit on top of the revenue stabilisation?
Yeah, I mean that's an interesting one. I mean, I certainly at the outset, I don't know if Neil and Ruth may remember this. There was a lot of questions about the structure. Did we understand this massive contract and what really was going to happen? But there is a good deal of clarity with a contract. You can read it, and it might take a lot of time to reading it, but to understand it, and actually it's clear what each party's rights and obligations are. And they are set out in a signed contract, which is signed by both parties, and it has therefore, it is therefore enduring. And that, once people have got over the initial hurdle of kind of understanding what does this contract really mean, what actually happens in various scenarios, I think that has been a positive feature. I think at the outset there was a lot of question marks of whether people really understood it well enough and whether it would work. I guess there are still, because it's a contract, it's a very detailed contract. There's significant restrictions on the generators and what can be developed. So if there's certain problems or issues that are kind of encountered during the construction phase, then clearly there are restrictions about capacities or changes and timings, which keeps the pressure on us generators. It's completely understandable why those restrictions need to be there. But of course there are clauses in the contract which help support in sort of unforeseen circumstances as well. So I think the private law contract initially was probably questioned, but has, with the support of the market understanding and advisors, there's now a very, very wide and deep pool of finance providers who feel like they understand it sufficiently well to be able to then commit capital. Is my view.
That's great. And if I could perhaps bring Neil and Ruth in. Ruth is being a bit modest because she was at DEC and helped to develop the policy in the first place. Could you perhaps delve a little bit into the history as to why these choices were made and how you think it's developed since you both at LCCC from the start?
I mean, I think when you said, Ollie, that, let's set the scene back in sort of 2010, I actually think just sort of a bit before that, there was obviously the renewables obligation was going through a few bumps in the road, shall we say, in terms of the fact that the government felt that solar generators were making too much money and turned the taps off fairly swiftly, and a lot of people felt that had, in a way, undermined their trust in the new RO as a support scheme and was making it difficult for them to then sort of seek capital for new projects. So there's that kind of backdrop of slight concern that the government can switch support on and off at whim or with a change of administration or change of policy. And yet these projects, they're large. Some of them were the ones that were trying to get away at that time, trying to get more offshore wind away, which wasn't really happening at scale at that time. These were large investments, really large investments. They couldn't be subject to a whim because there was billions up front, several years of development, and many, many years to pay back that investment. And therefore, that fear was from investors that, government, this would be subject to the next, policy whim and was not investable. And so I think one of the crucial things actually was probably the levy raising powers, because what it did was it took the funding of these contracts outside of the spending review rounds and the politics, I guess, that goes with direct exchequer funding and also the politics that goes, say, with something like the renewables obligation, whereby there's regulations, but there are certain powers within it where the government can, suddenly decide something's not eligible or is eligible, or suddenly change the rules, as we've seen with some other schemes. So I think it was that kind of backdrop that investors were pointing to and saying we need something a little bit more watertight for this scale of investment, and that's why we ended up with the CFD.
Neil, how do you think it's developed over the 7 years that LCCC have been managing these contracts?
Well, it's been really interesting, and Ollie, you prompted me to think about some of the the things we've done over the years, and very often in the first 4 or 5 years we're doing a lot of things for the first time, and looking at developing concepts in the contract, how the contract operates, how it works for various operational conditions, precedent, that sort of thing for the different technologies. But we've been through that journey now, and it's really interesting to see how we're looking at how that model can be applied to other technologies in this decarbonisation journey. But yeah, it's been really good. The feedback from investors is strong. The relationships that we build with our clients and our counterparties is one where I'm very keen to make sure that projects can run into problems, and where we can, we want to help, because these projects going in the ground, under the sea, on time and on budget is our success as well as yours. So we have aligned incentives. Yes, there are obligations in the contract, Ollie, which you correctly identify. But we're very keen to engage early and find solutions. And you quite rightly highlight that we act independently from our shareholder, the government, in the way that we decide on these projects. Of course, we can't do absolutely anything we want, and there are shareholder reserve matters, but there are aspects clearly many aspects in the way that we operate independently, which again I think is important for investors.
Yeah. So clearly we've had a development of the concept and the implementation of it. I'm interested then about the read across, Ruth, to new sectors. What is it that we want to take over to say CCUS or other sectors, and what is it about the contract that really appeals?
Yeah, so I think obviously the government is looking at using a form of the CFD. We've talked about the dispatchable power agreement for CCS on gas-fired power generation. That's, I think, again seen as a really positive thing by the industry, because it's a well understood mechanism now, and there's it's not having to go to financier and sell as quite a different mechanism. And I think the approach has been to retain everything that can be retained that is relevant from sort of the power CFD, and just look at creating a business model that ensures that gas-fired power generation with CCUS simply displaces unabated gas. So it is a top-up to renewables. It dispatches after renewables on the system, and so it performs that gap-filling role in our GB electricity system that we need. So I think that's a really sort of positive approach, and we're very supportive of that. They're also obviously looking at, for industrial, carbon capture on industrial plant, they're looking at having a CFD for that as well, and that is something that they've recently kind of published an update on the business models in October, and there we're quite interested to see and supportive of one of the proposals. I think the sort of minded to position of a carbon-based CFD. It will be combined with some upfront capital as well, which is slightly different, I think, to the sort of the power CFD model. But essentially this is to recognising the fact that there'll be investment in this equipment, but actually running the equipment at the industrial facility will be an ongoing operational cost which needs to be covered, and a contract is one way of doing that, which will really hopefully unlock private sector capital, which will mean the sort of amount of upfront capital the government needs to put into those emitters is probably minimised as far as possible. And obviously then they're also looking, you talked about regulatory asset base earlier for nuclear, but for the transport and storage network, which is going to be common in these clusters to a multitude of emitters connecting to one transport and storage network, that will be funded as a regulated asset base. And so they've consulted and talked about how that might be developed. But definitely, I think in the CCUS industry, we think that the CFD is a model that's proven to work for offshore wind, for other technologies with similar investment challenges, and we think that it's a good model to follow for CCUS.
So when you're talking to your members, are these the kind of things that they highlight as
Yeah,
benefits?
absolutely. And members have been really, really clear with the government over the last week or so that it's really, really important to get the business models done as soon as possible. They are actually on the critical path if we want to have 2 of these clusters operational by mid-2020s, which was the announcement. Obviously, HyNet in the northwest and the East Coast cluster are going forward, and the ambition is to have them operational by the mid-2020s. But that business model is absolutely critical path, because there may be lots of pots of money announced, and there was, and we really welcome that in the net zero strategy. Their capital, their upfront capital, de-risking capital. What we don't have yet is a budget, if you like, or a business model confirmed for the operational costs, and that is something that the financiers will want to see. So it's on the critical path, and we're really, really keen to see the development of that. And obviously, if we want to move quickly, then the best thing to do is repurpose something we've already got that works well, and not over-design or redesign it too much.
They're all up for recycling. Great principle. I'm interested that the CFD was designed originally back in the early 2010s. And market conditions were as they were. Has there anything changed that the CFD needs to respond to, or is there any particular aspect of how the market is developing that you think the CFD will need to develop to adapt to? Is there, Ollie, is that something that occurs to you?
I mean, from a financing market perspective, of course there was the crisis back at the end of 2008, 2009. But for well-structured projects, I think there's generally been sufficient availability of capital, maybe not in every single case, but for well-structured projects, there's been capital. And now, I mean, there is certainly a huge amount of capital coming from across the globe, investing in UK projects, UK offshore wind projects. Does something need to change? I'm not convinced something needs to change if we think that there's one of the aims is to bring in efficient debt financing and to bring in kind of the additional investors, shareholder investors, to enable a really ambitious pipeline of projects to get built out. Could things be improved? Maybe, but I don't know. I'm not sure what the policy teams are thinking. I mean, I do find it interesting, and I might be going slightly off piece, going to the wrong part of the agenda. But offshore wind has been a kind of a massive, I think, success story, kind of in the UK industry for the last sort of 5 years, in terms of the scale of build out and the cost reduction that's been achieved. And then other sectors are probably similarly, other subsectors within renewables are similarly well understood and kind of have a kind of a sufficiently low perception of risk, maybe onshore wind, solar, and are then capable of raising the finance. And then at the other end of the renewable scale, there's still emerging technologies, or technologies which are so CCUS, but others as well, where even for the CFD, the strike prices are just a world away from the strike prices which offshore wind is achieving under the competitive environment. Does that mean something needs to change? Because does one size fits? It's not one size fits all because you have the different prices, but one structure. Does that work? I mean, I'd be interested to know Neil's thoughts in terms of kind of with the overview across the different sectors. When you look at the different strike prices, do slightly different approaches potentially does it invite slightly different approaches for different subsectors?
Picking up on one of your earlier comments, Ollie, does anything need to change? One of the bits of feedback we get from investors that we talk to is that the stability of the regime is important. So not just the stability of price over the 15 years, but actually it's that the regime has been stable over the last 7 to 8 years, and that's important to investors. And so what we want to do is to make sure that this, I often talk about making sure the CFD remains relevant to the market, and that as new technologies come along on this journey to decarbonisation, that we can make sure that, if it needs tweaking, if it needs changing, then we can look at what those options are. It might be co-location. It might be as these technologies start to come together, co-location of let's say offshore wind and hydrogen or things like that. How do we accommodate that to make sure that the CFD is doing its job in terms of bringing forth capital on this journey to decarbonisation? So what you'll see is us working hard to make sure that the CFD remains, what I would say, relevant to the market and what investors want and what consumers need as well, and balancing those things out. In terms of the different technologies, clearly there are the different pots, and I'm sure BEIS will keep an eye on those pots and the technologies as they come forth to make sure that those emerging technologies are given the adequate support. The CFD is there to bring forth those new and emerging technologies, and you see the various rules and structures within the auctions to enable either budgets or capacity limits, etc., which will be allocated to ensure that those technologies can compete. But I think it's just really interesting to see how the CFD and the experience we've had over the last 7 years and the stability of the regime, I'm very keen that we continue to offer that stability and confidence to the investment community across all of these technologies. So it's a living thing.
And I think it's worth saying we've got similar mechanism that we want to have, but we've got different markets in many ways. So you're talking about the power market there and the auctions for power CFDs. The early CCUS contracts, there will be CFDs, or they'll be very, very similar to CFDs, building on all that good experience. But they will be bilateral. There's a bilateral process for the early projects, which is very similar, I think, to the sort of FID enabling for renewables process. And we talked about Beatrice earlier. Actually didn't go through auction. It went through a sort of competitive process that was different. So we're at that stage, I think, with CCUS, and you have to sort of think, at what point, will you have sort of technology neutral sort of auctions for things, or what rules apply? I think that needs to be thought about. But I think we're at quite a different point. I think with CCUS, we're just entering the mechanism, and it will be a bilateral process to begin with. And one of the really exciting things, I guess, I mentioned earlier, for industrial CCUS, a carbon-based CFD. So of course, that's not part of the power market, but it is going to be part of, say, a regional low-carbon hub. So what you might see is, a business industrial zone with, green and blue hydrogen and CCUS and offshore, so offshore wind for green hydrogen, blue hydrogen, clean steel with CCUS and things like that, all sort of sharing infrastructure. Maybe they might be sharing heat or energy, or also, in the case of the CCUS facilities and the capture facilities, sharing the transport and storage network. So I think we've just got to be mindful in developing all of these mechanisms that we understand those interactions and how it all fits together, and we don't get, they're different markets, but essentially they're in many ways sharing potentially resources or infrastructure, offshore and onshore. So it's just bearing that in mind, I think. And CCSA is also working with the Crown Estate and others, OGA and others, to think about how the offshore space is used effectively across the different technologies, and the same discussions, I guess, will be had about making sure that the projects are working together effectively and the incentives are working properly.
And
of course,
like the sort of thing you were talking about in terms of the flexibility in moving forward.
And decarbonisation of industry is a critical aspect of this journey, and there are strong links between decarbonisation of industry and the rollout of renewable projects like yours, Ollie.
Absolutely.
Steel and other aspects of how you're constructing these projects. So it's looking at that value chain. It's incredibly important.
Yeah, there's a sort of multifaceted balancing act here in terms of maximising the build out, what can be built out now, to keep the momentum going, I suppose. Making with a view to the long term, making sure that the emerging technologies are supported enough to come on, and then the industrial side. Yeah, I mean, I don't envy kind of that part of any role, but I suppose that's where constant, maybe not change, but constant flex within the system setup is probably needed. I mean, there's certainly been a huge amount of offshore wind kind of appetite and lots of projects being unsuccessful in the auctions, last couple of auctions, and I guess there'll be a huge number of projects kind of bidding for the next auction, and with every prospect of being developed, it's subject to being successful in the auction because the technology is now at a stage where it's proven, and the financing market is really behind it as well, which means they can go ahead.
Can I probe a little with that one? Ollie talked about this wall of money, and Ruth, you referred to the fact that the CCUS is about where offshore wind was, 2014-ish with the FIDA contracts. What's your perception in terms of the willingness of investors and lenders to come to the CCUS market?
I don't think we're going to have a problem finding people who want to invest in these technologies. Not at all. We're having those conversations all the time with people that are really keen to get into this market, and really welcoming the government setting out an ambitious target of targets all the way out to 2050 actually for carbon dioxide stored in the UK. 20 to 30 million tonnes by 2030 is the near-term target, and we talked about the 2 clusters operational mid-2020s, a further 2 by 2030. This ambition now that's set out in the net zero strategy is really exciting investors who want to get involved. The thing that's sort of missing at the moment that government has said they're going to look at in next year and set out is this kind of funding envelope for the operational period. So what is going to fund, if you like, LCC's payments under these contracts, assuming it's LCC, that's the counterparty there, which I think is the intent, is what is that? One of the key things is the levy that you have for power CFDs. That they know that you can raise that money and pay under the contract that stable revenue. We don't yet have a kind of clear vision for, say, industrial CCUS as to how that is going to be funded. So we know how the contract is how they envisage the carbon-based CFD to work, but we don't actually have that revenue support sort of funding envelope set out, say, to 2030 or that kind of visibility.
Do you think that'll be a problem when it comes to financing? The people will see that risk and go, Treasury could step in and could throttle back the money.
And I think the challenge is I don't think contracts can be signed without knowing that can be funded. I think that would be problematic, and I understand the government wants to publish, and set out something on that next year, which we'd really, really support because it is on the critical path for deploying the clusters. And it just sort of comes back really to, I suppose, maybe even thinking also about the power CFD and the future of that is the sort of delivery plan that was published, at the start of EMR, which set out sort of the levy control framework, a clear sort of ambition of how much the government wanted to do under the CFD. I think that was really, really powerful in getting people to pile in to, not maybe the first projects were still quite expensive, but the second and third rounds of projects because they could see that there was sufficient support there for that, and I think that's what we all need for CCUS too, particularly on industrial emitters, because it is just an added cost to running their business, so they need that certainty.
Perhaps you could unpack a little bit the model for industrial CCUS, because it is quite different. Will be exchequer funded, not levy funded, as you've said, and also it's carbon based. So perhaps you could explain how that translation is going to happen in that particular sector.
Yeah, so when we say carbon based CFD, what that means is instead of using, as in power CFDs, there's a reference price, which is the electricity price, and it's day ahead for wind. It's a base load market reference price for biomass and others. In a carbon based CFD, you actually just take the carbon price and effectively the cost of operating the plant with the capture technology, and basically the top up is the difference between those two things. So you make sure that that plant always covers its if you like, operational cost penalty of having the CCS, so having clean operations, and obviously as the carbon price rises, then the amount that has to be topped up would get smaller, and so it also sort of supports the carbon price being a driver in the future for deployment of those technologies at scale. So it's a very similar concept, but it's just using the carbon price instead of a power price, because obviously for industrial emissions that's the relevant thing. And then there is also for some very heavy emitting sectors, there are actually already free allowances under emissions trading schemes, so those would be sacrificed as well. They would not be needed, so there's a value to those, and that can also be used either to support the project or perhaps passed on to help pay for the storage. So there's that concept of working within the carbon market arrangements rather than kind of separately to them. So we think that looks really sensible and encouraging, and we've also been sort of looking at other schemes around the world, like the SD++ scheme in the Netherlands, which is actually carbon-based CFDs for power and industrial. But obviously in the UK, we're just looking at it for the industrial emitters at the moment. And then there's also a proposal to potentially have a CFD for hydrogen as well, blue and green hydrogen, and that's subject of a government consultation and as well. So I'm sure Ollie will talk about green hydrogen, but for blue hydrogen, again, we think that could be a really useful business model. And I just go back to what I said earlier about just making sure that all these things, that we keep them as straightforward as possible, and that we do build in agility into them to adjust them, but that the fundamentals are fairly solid in order for investors to come in.
That's the point that Neil made, actually, which I should have made as well. But it absolutely it has been, I think, very important that the regime has remained stable. You know, the structure of the power CFD has remained stable and understood. So there's kind of thousands of pages of due diligence done for these projects, and so a lot of it, is on the CFD and the revenue arrangements. And now there's still hundreds of pages on it, but people know what's in those hundreds of pages. But if it was to change, then the whole, the ability to deliver the projects would become much more difficult, and would take a lot longer, because suddenly people have got to get used to something that's a little bit different. And if it's only a bit different, then it's going to raise a lot of questions, and a lot of people kind of scratching their heads wondering, does this matter or not? So yeah, absolutely, kind of something that's enduring in terms of the setup is really important to make sure everyone knows what they're dealing with. Yeah.
Neil, perhaps you could comment on, Ruth has talked about how there's future ideas for how we can spread that. What's your view on the pipeline of new things that we could do with the low carbon contracts beyond CCUS, maybe hydrogen, or are there other things that you think that come along?
So, I mean, there are other ideas around low carbon aviation fuel, which I think has been mentioned, and also bioenergy CCS and greenhouse gas removal technologies. So, you know, as these technologies come along, then, you know, government will start to perhaps look at those, and we will support that process using our experience of, you know, implementing the CFD and working with investors and projects to think about how can that mechanism be used to help bring forward these technologies, and ultimately give confidence to investors to invest. And Ruth talked about the early projects, you know, on power, CCUS and industrial. Then we really are looking at the, you know, those early first of a kind projects, and how can we give the confidence to those projects to invest and hopefully go on that same journey that renewable electricity has been on, where we've seen some fundamental shifts in the economics of these projects. And, you know, Ollie, as you said, it comes from getting these projects, the first projects away. The supply chain learns how to achieve economies of scale, bring down the cost of the projects ultimately, and deliver, you know, either carbon savings or electricity at ever more competitive prices, which ultimately benefits the consumer. And the other aspect of this is obviously the economic growth and opportunity that it provides to the UK, and which is a really exciting opportunity.
Fantastic.
Absolutely.
Well, so I think we've had a really interesting conversation. I think that's been really helpful, hopefully for the viewers, to see what it is about this structure that's really been successful. I'm going to ask everyone to do a last round of comment if there's anything they particularly want to highlight what we've said. Ollie, do you want to go first?
You're putting me on the spot now. I mean, I've probably made most of the key points, which is that the CFD, the strike price, the revenue predictability that gives is really important versus something which has more risk associated with wholesale market prices. I mean, there's been a huge amount of volatility in those prices just in this last year, and it's really demonstrated the benefit of having the CFD. I think the regime works well. It'll be interesting. I think it'll be interesting to see what does happen, how the sector evolves, because, you know, the offshore wind, there's been a huge number of projects that are now being developed. There's a huge number more which organisations would like to develop. The strike prices are very low, and I guess it'll be interesting to see how that develops without changing fundamental things about the regime, which would then risk putting the brakes on the sector. So I'm focused on delivering the Dogger Bank wind farm, which I forgot to mention at the start. You know, once done, will produce 5% of the UK's electricity. So that is for me, that's the focus. That's a really important project, and I will be very interested to see how things move for the next ones.
Ruth, do you have a final comment for us?
Yeah, I mean, I think just in summary, it's been a bit stop-start with CCS in the UK over the last 10 years. So, you know, investors probably have a reason to be wary, in a similar position to renewables 10 years ago. And I think, nevertheless, the announcements the government's made recently are cause for excitement and for people to now be looking at it as a serious investment proposal in the UK and especially in the cluster regions around the UK, where they've made huge strides over the last 10 years themselves to pull together proposals for their regions that are really exciting. And I think the revenue support mechanism, the business models, we call them, the CFD designs for both the carbon-based CFD for industry, the dispatchable power agreement for power, CFD for hydrogen. These now are really on the critical path, and I just wanted to reiterate that. They're really, really crucial to get those done and to be very, very clear on how they're going to be funded, and then I think we will see people piling into this sector. I don't think the money is going to be a problem.
That's good note. And Neil?
I guess my final comment would be that Low Carbon Contracts Company sits, I think, in quite an interesting position between government and the sector. And when I say the sector, it's actually sectors because there's an ever-growing group of sectors that we deal with. And we want to work with investors, developers, with government, and our sole ambition is to see how we can make this work and be able to communicate with all parties and use our experience of the last 7 years to see how it can be applied, working with trade bodies, as I said, investors, developers, lenders, promoting and seeing how we can make sure that the CFD is used in a way to be able to bring forth these projects and give confidence to investors to invest, and working with government as well. And that leaves us, and that means hopefully we're quite an important cog in that machine. And hopefully, ultimately, we can achieve some of the great things that have been done in power so far and expand it into these other sectors.
Okay, well, thank you, Neil. Thank you, Ruth. Thank you, Ollie. Thank you all for your attention, those who have been watching this live stream and will be watching it online afterwards. I hope you found it informative and informed. My name's Gordon Edge, and thank you very much for your attention.